I pay attention to Walmart, always have. Not because I own significant shares, though Berkshire's held some over the years, but because Walmart tells me things, important things. Things about the American consumer, about the economy, about retail, about competition, about management quality, about moats and competitive advantages. Walmart is like a thermometer for the entire retail sector. And right now, that thermometer is showing readings that fascinate me. Most people think about Walmart as just another retailer, a place to buy groceries and household goods at low prices. But I see something much more interesting. I see one of the most formidable competitive machines ever built. I see a business that's survived and thrived through decades of disruption. I see management that's adapted brilliantly to changing circumstances. I see a moat that's actually widened over time despite enormous competitive pressure. And I see signals about the broader economy that you can't get anywhere. Let me explain what I'm watching and why it matters. Because understanding Walmart means understanding fundamental things about business, competition, and value creation. And right now, in this particular economic moment, what Walmart is doing and how it's performing tells me more about where we are and where we're heading than almost any other single company. I've always loved studying great retailers. Retailing is a brutally competitive business. Margins are thin, competition is intense, consumer preferences change constantly, technology disrupts everything. Most retailers fail. The ones that survive for decades must be doing something very right. They must have genuine competitive advantages, real moats, excellent management, something special that protects them from the forces that destroy their competitors. Walmart is one of those special retailers. Founded in 1962 by Sam Walton. I knew Sam, admired him tremendously. One of the greatest businessmen I've ever encountered. He built Walmart on a simple principle: everyday low prices. Not sales, not promotions, not gimmicks, just consistently lower prices than competitors. This sounds simple, but executing it requires brilliance in operations, logistics, purchasing, inventory management, real estate, and culture. Sam built a machine that could deliver on that promise. And his successors have maintained and improved that machine for decades. What makes Walmart fascinating to watch right now is how it's navigating multiple simultaneous challenges. E-commerce disruption, changing consumer behavior, inflation, labor pressures, supply chain complexity, competition from Amazon, Target, dollar stores, and countless others, economic uncertainty. Each of these challenges has destroyed other retailers. Sears, Kmart, Toys R Us, countless others failed because they couldn't adapt. But Walmart is not just surviving, it's thriving. Understanding how and why tells you everything you need to know about what creates lasting competitive advantage. Let me start with what I'm watching most closely: consumer behavior. Walmart serves 150 million Americans every week. 150 million. That's nearly half the country. These aren't just rich people. These aren't just poor people. Walmart serves everyone. When you serve that many people, you see things, you see patterns, you see changes in behavior before anyone else does. You see the economy not through statistics, but through what people actually buy. Right now, Walmart is telling me that the American consumer is under pressure but resilient. How do I know this? By watching what Walmart reports. What categories are growing? What categories are declining? How much of their growth is from unit volume versus price? What customers are trading down to private label? How traffic patterns are changing? All of this data, which Walmart reports quarterly, paints a detailed picture of consumer health. What I'm seeing is fascinating. Walmart's grocery business is extremely strong. People need food. They'll always need food. But within groceries, there are shifts. More private label purchases, more value-oriented choices, less premium product. This tells me consumers are feeling stretched, they're being more careful, more price conscious, they're trading down slightly but still buying. This is not recessionary behavior. Recessionary behavior is cutting back on quantity. What we're seeing is switching to lower price points while maintaining volume. That's pressure, not crisis. General merchandise is weaker. Discretionary purchases, things people want but don't need. Electronics, home goods, apparel, these categories are softer, not collapsing, but growing more slowly or even declining slightly. This also tells me consumers are being careful. They're prioritizing necessities, being more selective about discretionary purchases. Again, this is pressure, not panic. People aren't stopping discretionary spending. They're just being more thoughtful about it. The mix tells the story. Strong groceries, weaker general merchandise. This is classic economic uncertainty behavior. Consumers are uncertain about the future, about their jobs, about inflation, about their finances, so they focus on essentials. They're more careful with discretionary spending. They stretch their dollars, but they're not in crisis mode, not yet. They're still functioning, still consuming, just more carefully. This matters enormously for understanding the economy. Government statistics tell you what happened, lagging indicators. But Walmart tells you what's happening right now, this week, this month. Real-time consumer behavior from half the country. And what Walmart is seeing is an economy that's slowing but not collapsing, consumers that are pressured but functioning, uncertainty that's creating caution but not panic. This is valuable information, more valuable than GDP reports or inflation statistics, because it's actual behavior, not statistical models. The second thing I'm watching closely is market share. Walmart has been gaining market share consistently across multiple categories, taking share from competitors. This is remarkable because market share gains in mature industries are hard. Retail is not growing fast. Population growth is slow. Per capita consumption is relatively flat. So when Walmart gains share, it's taking it from someone else, from competitors who are losing. Understanding how Walmart takes share tells you about competitive advantage. Walmart takes share through execution, through being better at the fundamentals. Lower prices, better inventory, cleaner stores, faster checkout, more convenient pickup and delivery options, better website and app, more locations, longer hours. These aren't glamorous advantages. They're not innovative technologies or revolutionary business models. They're just basics executed brilliantly, and basics executed brilliantly beat fancy. Strategies executed poorly every single time. Let me give you specifics. Walmart's e-commerce business is growing rapidly, double-digit growth quarter after quarter. This matters because e-commerce is where retail is moving. Amazon proved that. Every retailer needs strong e-commerce or they die. Walmart initially struggled with e-commerce. They were late. They made mistakes. But they learned, they invested, they built infrastructure, and now they're winning. Their e-commerce growth is actually accelerating while Amazon's growth is slowing. That's market share gain in the most important battleground. How is Walmart winning in e-commerce? By leveraging their physical stores. They have over 4,000 stores in the United States, 4,000 distribution points within 10 miles of 90% of Americans. This is an enormous advantage. They can offer pickup within hours, same-day delivery, easy returns. Amazon can't match this without building thousands of physical locations, which defeats their cost advantage. Walmart stores, which looked like a disadvantage in the e-commerce age, turned out to be a massive competitive advantage. Classic example of apparent weakness becoming actual strength. Walmart is also gaining share in groceries, taking share from traditional supermarkets and from dollar stores. Groceries are the most important category because they drive frequency. People buy groceries every week. If you win groceries, you win customer relationships. You get them in the door or on your app regularly. Then you can sell them other things. Walmart understands this. They've invested heavily in fresh food, in private label quality, in competitive pricing, and it's working. Their grocery market share keeps growing The share gains tell me Walmart's moat is widening. Competitive advantages are strengthening, not weakening. In most industries, technological change erodes moats, digital disruption levels the playing field. But in retail, Walmart is using technology to strengthen its position, using data to optimize inventory, using automation to reduce costs, using their scale to invest in capabilities smaller competitors can't afford. The moat is getting wider. That's rare. That's valuable. That's what makes truly great businesses great. The third thing I'm watching is profitability. Walmart operates on thin margins, always has. Retail margins are thin because competition is intense. Walmart's business model is built on volume, not margin. Sell enormous quantities at small profit per unit. This requires incredible operational efficiency. Any waste kills profitability. Any inefficiency destroys the model. So watching Walmart's margins tells you about their operational execution. Right now, Walmart's margins are expanding. Not dramatically. We're talking about basis points. But in a low margin business, basis points matter enormously. Margin expansion tells me Walmart is getting more efficient. They're leveraging their scale better. They're optimizing operations. They're using technology effectively. They're managing costs tightly. This is impressive. In an inflationary environment where most retailers are seeing margin pressure, how is Walmart expanding margins? Multiple ways. First, scale benefits. As Walmart grows, as they increase volume, they spread fixed costs over more units. This improves margins automatically. Second, private label growth. Walmart's private label products have higher margins than branded products. As consumers trade down to private label, Walmart's mix shifts toward higher margin products. Third, automation and technology. Walmart is investing billions in automation, AI, and technology. These investments reduce labor costs, improve inventory management, reduce waste. The benefits are showing up in margins. Fourth, advertising. This is fascinating. Walmart has built an advertising business. Brands pay Walmart to advertise on Walmart's website and app. This is almost pure profit. High margin revenue that drops directly to the bottom line. Walmart's advertising business is growing rapidly. It's still small compared to Amazon's, but it's growing faster. And it's transforming Walmart's profitability profile. This advertising revenue is why Walmart can keep prices low while expanding margins. They're making money in new ways that don't require raising prices. The margin expansion tells me Walmart's business model is working. They're not just growing, they're growing profitably. They're not sacrificing profitability for growth. They're achieving both. This is the hallmark of excellent business. Poor businesses can grow by sacrificing margins. Good businesses can grow while maintaining margins. Excellent businesses grow while expanding margins. Walmart is in the excellent category. The fourth thing I'm watching is capital allocation. How does Walmart use the cash it generates? This tells you about management quality, about their priorities, about whether they're focused on long-term value creation or short-term appearances. Great management allocates capital brilliantly. They invest in growth. They maintain the business. They return cash to shareholders appropriately. Poor management wastes capital on empire building, foolish acquisitions, or excessive buybacks at high prices. Walmart's capital allocation is excellent. They're investing heavily in the business. Billions in technology, billions in supply chain, billions in store remodels, billions in e-commerce infrastructure. These investments are necessary to compete, to maintain and extend their competitive advantages, to adapt to changing consumer behavior. Management understands this. They're not starving the business to boost short-term earnings. They're investing for the long term. At the same time, Walmart returns cash to shareholders, dividends, share buybacks, but they're not doing excessive buybacks. They're not borrowing heavily to buy back stock. They're being balanced. Investing in the business first, returning excess cash to shareholders second. This is the right priority order. Too many companies buy back stock to boost earnings per share while underinvesting in the business. That's short-term thinking. Walmart is thinking long-term. The acquisitions they've made have been strategic. They bought Jet.com to accelerate e-commerce learning. Expensive but valuable. They've bought technology companies to improve capabilities. They've entered India and other international markets thoughtfully. They've exited markets where they couldn't win, like Germany and Korea. This shows discipline, willingness to admit mistakes, focus on markets where they can win. These are all signs of excellent capital allocation. Management quality matters more than most people realize. A great business with poor management becomes average. An average business with great management becomes good. Walmart has both a great business and great management. The combination is powerful and rare. Most great businesses eventually get poor management. Founder's vision gets diluted, bureaucracy takes over, short-term thinking dominates. Walmart, 50 years after Sam Walton started it, still has the culture and management quality that made it great. That's remarkable. That's valuable. That's worth paying attention to. The fifth thing I'm watching is competition. How are Walmart's competitors doing? Because competitive dynamics tell you about industry structure, about whether this is a winner-take-all situation or a stable oligopoly, about whether Walmart's success comes at competitors' expense or whether the whole industry is healthy. Understanding competitive dynamics is crucial for evaluating Walmart's long-term prospects. Right now, the competitive picture is fascinating. Amazon is still growing but slowing. Their retail business is mature, growth rates are declining, they're facing margin pressure, their advantages in e-commerce are eroding as traditional retailers like Walmart catch up. Amazon remains formidable, but they're not the unstoppable force they seemed 5 years ago. Walmart has figured out how to compete and compete successfully. Target is struggling. They had a great run during the pandemic, but now they're seeing traffic decline, inventory problems, margin pressure. Target serves a more affluent customer than Walmart. In uncertain times, that customer cuts back more dramatically. Target also lacks Walmart's scale advantages. They're 1/10 Walmart's size. They can't match Walmart's cost structure. They can't invest as heavily in technology. The competitive gap is widening. Dollar stores are facing challenges. Dollar General and Dollar Tree grew rapidly by serving rural and low-income communities, but they're seeing same-store sales pressure, competition from Walmart, inflation pressuring their customers more severely, labor problems. Dollar stores look like the future of discount retail, but their model has limitations. Limited selection, limited fresh food, inconvenient locations. Walmart offers more selection, better quality, and increasingly competitive prices. The dollar store advantage is eroding. Traditional supermarkets are losing share. Kroger, Albertsons, regional chains, they're being squeezed by Walmart on price and Amazon on convenience. Their margins are thin. Their scale is insufficient. Many will consolidate or exit. The grocery industry is consolidating, and Walmart is the winner in that consolidation. They're taking share from everyone, from premium grocers, from traditional supermarkets, from dollar stores, from online pure plays. Walmart is winning across all customer segments. This competitive picture tells me Walmart is in a dominant position. They're not facing existential threats. They're not being disrupted. They're doing the disrupting. They're taking share, growing profitably, investing in advantages. This is what you want to see. Dominant companies in strong competitive positions generate excellent returns for decades. They compound, they create wealth, they're worth owning. The sixth thing I'm watching is innovation. Not flashy innovation, not revolutionary technology, but practical innovation that improves the business, that solves problems, that creates value for customers and shareholders. Walmart's innovation over the past decade has been remarkable and largely unnoticed by people focused on sexier technology companies. Walmart has invested over $70 billion in capital expenditures over the past 5 years. $70 billion. That's more than most companies' entire market capitalizations. Where did that money go? Technology, automation, supply chain, e-commerce infrastructure, store remodels. This investment is transforming Walmart from a traditional retailer into a technology-enabled retail platform. The change is profound, but because Walmart is huge and moves deliberately, people don't notice. Let me give you specifics. Walmart has built automated fulfillment centers, robots that pick orders, AI that optimizes inventory, machine learning that predicts demand. These systems reduce costs, improve accuracy, and speed delivery. Walmart can now fulfill online orders profitably, something that was impossible 5 years ago. This technological capability is a massive competitive advantage. It allows Walmart to compete with Amazon on convenience while maintaining the cost advantages of their physical stores. Walmart has transformed their stores into fulfillment centers. Associates pick orders for online customers. Customers can pick up orders without entering the store. This model is brilliant. It leverages existing assets. It increases store productivity. It creates convenience, customers value, and it's profitable. Amazon can't match it without building physical locations. Target is trying but lacks the scale. Walmart's store network, combined with technology, creates an unbeatable combination. Walmart has built a membership program, Walmart Plus, Amazon Prime competitor, subscription that includes free delivery, gas discounts, and other benefits. Still small compared to Prime, but growing. Memberships create loyalty, recurring revenue, higher customer lifetime value. Walmart is learning from Amazon, adapting their model, competing effectively. The membership program might become as valuable as Amazon Prime over time. That would be worth tens of billions alone. Walmart is experimenting with healthcare. They're opening health clinics in stores, providing affordable primary care, vision, dental, mental health services. This is early, but potentially transformative. Healthcare is a massive market, underserved in many communities Walmart serves. If Walmart can provide quality healthcare at low prices, it could revolutionize the industry, become a major profit center, drive store traffic, create loyalty. This is thinking big, taking risks, innovating beyond their core, classic signs of great management. The innovation tells me Walmart is not complacent. They're not resting on their dominance. They're pushing forward, investing in the future, adapting to change, creating new advantages. This mindset, this continuous improvement orientation, is what separates companies that dominate for decades from companies that peak and decline. Walmart has the mindset of a company that will dominate for decades more. The seventh thing I'm watching is international performance. Walmart operates in over 20 countries. International operations are over 20% of revenue. Understanding international performance tells you about Walmart's ability to replicate their model in different contexts, about management's capability beyond their home market, about growth potential as they expand globally. Walmart's international performance is mixed. They've succeeded in some markets. Mexico is excellent, Canada is solid, Central America is good, but they've struggled in others. They exited Germany, exited Korea, struggled in China, had challenges in India, though that's improving. This mixed record tells me Walmart's competitive advantages are somewhat specific to the U.S. market. Their model doesn't transplant perfectly to every culture and competitive environment. This doesn't bother me much. The U.S. market is enormous. It's $400 billion in annual revenue, growing steadily, highly profitable. If Walmart simply maintains dominance in the U.S. and achieves modest success internationally, that's enough. They don't need to conquer the world. They need to compound steadily in their core market while exploring opportunities elsewhere. That's what they're doing. The international challenges also tell me Walmart is rational. They entered markets, tried to win. When they couldn't, they exited. They didn't throw good money after bad, trying to save face. They didn't persist with failing strategies out of pride. They were rational, pragmatic, willing to admit defeat and move on. This is rare in large corporations. Usually pride and bureaucracy prevent rational exits. Walmart's willingness to exit markets shows strong management. The eighth thing I'm watching is culture. Company culture is intangible, hard to measure, easy to dismiss, but it matters enormously. Culture determines how employees behave when management isn't watching, how they treat customers, how they solve problems, whether they take initiative or wait for direction. Strong cultures create competitive advantages. Weak cultures create vulnerabilities. Walmart's culture, established by Sam Walton, emphasizes frugality, customer service, and respect for associates. Sam flew coach, drove an old pickup truck, stayed in cheap motels. He insisted that executives stay connected to stores, to customers, to frontline associates. He created a culture that valued substance over appearance, results over status. This culture persists decades after Sam's death. You can see it in how Walmart operates, how they allocate capital, how they treat employees, how they make decisions. I look for signs that culture is eroding: executive excess, disconnection from customers, bureaucracy, overwhelming initiative, short-term thinking. I don't see these signs at Walmart. Management is accessible, compensation is reasonable relative to peer companies, decision-making seems rational and customer-focused, investment is long-term. These are all signs of healthy culture. Culture matters more during challenges. When times are good, any culture works. When times are tough, culture determines who survives. Walmart's culture of frugality and operational excellence is perfect for competitive retail. It creates discipline, focus, continuous improvement. These characteristics help Walmart navigate challenges better than competitors, help them make tough decisions, maintain advantages, keep winning. Now, let me pull all these observations together because individually they're interesting, but collectively they tell a coherent story about Walmart and what that story means for understanding the broader economy and investment landscape. What Walmart tells me is that the American consumer is under pressure but resilient. Consumer behavior is shifting toward value, toward necessities over luxuries, toward being careful without panicking. This matches an economy that's slowing but not collapsing, that faces inflation pressures but not crisis, that's uncertain but functional. This is valuable information for understanding economic conditions. What Walmart tells me is that competitive advantages matter more than ever. In a world of technological disruption and changing consumer behavior, sustainable competitive advantages are rare and valuable. Walmart has strengthened their moat through scale, technology, investment, and execution. They're winning because they're better at basics. This tells me that in investing, focusing on companies with genuine competitive advantages is more important than chasing growth or trends. What Walmart tells me is that great management creates lasting value. Walmart could have become complacent, could have failed to adapt to e-commerce, could have been disrupted by Amazon, but they didn't. They adapted, they invested, they competed, they won. This happened because management was excellent. They understood the business, made rational decisions, allocated capital well, maintained culture. Management quality matters enormously, more than most investors appreciate. What Walmart tells me is that boring businesses can be wonderful investments. Walmart isn't sexy. It's not growing 40% annually. It's not revolutionizing anything. It's just a retailer selling everyday goods at low prices. Boring. But boring done excellently creates enormous value. Walmart stock has compounded nicely over decades. Dividends have grown. Shareholder value has increased. Boring works often better than exciting. What Walmart tells me is that scale still matters. In a world that celebrates agility and disruption, people forget about scale. But scale creates real advantages. Walmart's scale allows them to outinvest competitors, to operate at lower costs, to absorb challenges that would destroy smaller companies. Scale isn't everything, but it's something valuable, something that protects and enhances competitive position. What Walmart tells me is that adaptation beats innovation. Walmart didn't invent e-commerce, didn't pioneer online retail, didn't create revolutionary business models. They adapted, they learned, they applied their existing advantages to new challenges. This adaptation was more valuable than most innovation. Because it leveraged existing strengths rather than requiring new capabilities. Adaptation is underrated. Most companies should focus less on innovation and more on adaptation. What Walmart tells me is that the retail apocalypse narrative was wrong. For years, people predicted retail's death. Amazon will kill everyone. Physical stores are finished. Shopping malls will disappear. But it didn't happen. Retail is changing. But it's not dying. Physical stores integrated with e-commerce create powerful combinations. Walmart proved this. The apocalypse narrative was too simplistic. Reality is more nuanced. Winners and losers exist in every industry. Walmart is a winner. So what does all this mean practically? For investors, for business people, for anyone trying to understand the economy and markets, several lessons emerge from watching Walmart. First, watch what consumers do, not what they say. Surveys tell you sentiment. Walmart tells you behavior. Behavior is more reliable. Right now, behavior says pressure but resilience. Caution but not panic. This is actionable information. It suggests recession is unlikely near term, but growth will be modest. Inflation will remain a concern. This consumer posture favors value-oriented businesses like Walmart, hurts premium brands, hurts pure luxury, helps necessities. Second, invest in companies with wide moats, competitive advantages, protect returns, allow compounding over decades. Walmart's moat is scale, logistics, excellence, and increasingly technology. These advantages are durable, difficult to replicate, valuable. When evaluating investments, focus on moat width and durability. Companies without moats compete on price. Margins compress, returns disappoint. Companies with moats maintain pricing power, grow steadily, compound nicely. Third, pay attention to capital allocation. How management uses cash tells you everything about their quality and priorities. Walmart invests heavily in the business while returning cash to shareholders. This is the right balance. They're not starving the business for short-term earnings. They're not empire building through foolish acquisitions. They're being rational, long-term focused. This is what you want. When evaluating companies, study capital allocation carefully. It reveals whether management creates or destroys value. Fourth, culture matters. Intangible but important. Companies with strong cultures outperform during challenges. Walmart's culture of frugality and customer focus serves them well. When evaluating investments, try to understand culture, talk to employees, observe behavior, read between the lines in communications. Culture can't be faked long-term. It reveals itself, and it matters. Fifth, boring often beats exciting. Walmart is boring, but it works. It compounds. It creates value steadily. Meanwhile, exciting companies often disappoint. They get hyped, overvalued. They fail to deliver. Their excitement masks fundamental weaknesses. Don't chase excitement, chase quality. Chase durable competitive advantages. Chase strong management. Chase businesses that work. These are often boring, but boring pays. Six scale is undervalued. In a world celebrating startups and disruption, scale gets dismissed. But scale creates real advantages. Walmart's scale is a massive competitive advantage. It allows capabilities competitors can't match. When evaluating businesses, consider scale. How does size help or hurt? In retail, size helps enormously. In other industries, size might hurt by creating bureaucracy. Context matters, but don't dismiss scale. It's real. It's valuable. Let me now address whether Walmart is a buy at current prices, because observing and understanding a business is different from deciding whether to invest. Whether something is worth watching is different from whether it's worth owning. Price matters, always. Even wonderful businesses are poor investments at wrong prices. Walmart trades at around 23 times earnings. That's not cheap. It's not expensive. It's reasonable for a quality business with steady growth and strong competitive position. The dividend yield is around 1.5%. Not high, but growing steadily. reliable. The business grows mid-single digits. Earnings grow slightly faster as margins expand. This is not explosive growth, but it's steady, predictable, sustainable. Is this attractive? Depends on alternatives. Compared to Treasury bills yielding 5%, Walmart needs to deliver more than 5% annual return to be attractive. Can it? Probably. Mid-single-digit earnings growth plus dividend plus multiple expansion over time likely delivers high single-digit returns. Not spectacular, but reasonable, safe, steady. For someone wanting exposure to consumer resilience, retail evolution, and quality management, Walmart at current prices is reasonable. But I'm not saying rush out and buy. I'm saying Walmart is worth watching, worth understanding, worth having on your radar. Whether it's worth buying depends on your portfolio, your goals, your time horizon, your alternatives. For Berkshire, with our size and complexity, Walmart has to be a massive position to matter. We've held it at times. We might again, but it's not a core holding right now. That doesn't mean it's not attractive. Just means it doesn't fit our specific needs perfectly. For individual investors, Walmart is interesting.